So, welcome, Perennial Pride listeners. Thanks for joining me as always. If you're enjoying this, you're finding this material educational, and I'm trying to bring on unique topics and guests, please like and share, please, because we want to make sure as many people as can benefit from just learning these things. What you do with it is obviously a different animal, but getting the word out is so key. And I really love bringing on unique guests with different experiences, because I do believe we all benefit from hearing from them. And we unfortunately can see the same thing sometimes, and we go a different route than that other person. And I always try to bring in young, bright minds to the table here. So today I have Keshav, and he helped me pronounce that. Thank you. Kolur. Keshav, damn it.
You're good.
Keshav. He's the principal at Clive Capital. Right, and he's a great guy. He's going to tell more about that. He's really helping a lot of successful W-2 folks, whether you're an engineer or professional, explore the world of real estate investments. And not that you have to own them and clean all the toilets, but help you match up with other operators who can really benefit you from a passive income perspective. And he has a background in software engineering, so I'm sure that comes into play to some degree analytically. And so, Keshav, welcome to today's show. Thanks for joining me.
Yeah, thanks so much for having me on, Tom. I'm excited.
That's awesome. So I know before we get started recording, there's a lot of connection points, and you're outside the probably multiple decades of age difference. You are still a second generation here, and your parents came over right from India. And you started in this world and walked down the educational route, right? So tell us a little bit about your sort of background, and I know getting into it at such a young age of real estate. Like, how did that happen, right, while you're working a job? So walk us through some of that journey.
Yeah, sure thing. I graduated college about 6 years ago now. I'm getting old too, so that was the backside of my eyes right there. And coming out of college, I always knew that I didn't want to work for someone else for 40 years. I initially, the reason I didn't pick software engineering as a major was my understanding of it was just sitting behind a desk and working.
Mm.
That's true, but the part I didn't realize is that's honestly most jobs nowadays. In a cubicle, right? That's what I wanted to avoid. That's why I picked mechanical engineering. But again, I came to the realization that all jobs in today's age are sitting in front of a desk and working for the most part, like white collar jobs. That's why I'm wearing this today.
Yeah.
And so, but coming out of college, I knew I'd want to work for someone else for the rest of my life. So I knew that had to involve financial freedom. So I read Rich Dad, Poor Dad, purple book that gets a lot of us into this game. And that got me thinking about real estate as an investment class, not necessarily syndications, which is what we do now, which I'll go into a little bit later. But that got me thinking I should go out and buy rental properties. So at the time, my first job out of college was in Detroit. And on the side, I became a realtor about 5 years ago now. I got licensed on Leap Day, so February 29th, 2020. And we all remember what happened. 2 weeks later, COVID struck. Markets shut down. Later that summer, when markets opened up, I helped a few folks buy and sell homes. Used that capital and also the capital I'd saved up from working as a software engineer at my W-2, started looking at rental properties to buy in the Detroit area, single-family homes. And luckily, before I went too far down that rabbit hole, one of my really good friends from college sent me a Reddit thread about this guy who owned 40 single-family homes at his peak and started transitioning over into buying apartment buildings. And to me, that sounded cooler than just buying one home at a time. And then he also said that one, it's more profitable to invest into apartment buildings. The tax benefits are better. And third, it's not a pain in the butt. It can be a passive investment opportunity where you don't have to, like you said, actively manage the toilets, the tenants, and the trash. That really piqued my interest. But it sounded too good to be true because I didn't know anyone who's doing this type of investing. I didn't know anyone who's doing real estate investing, let alone this kind of investing, which is called investing into syndications. I took a year, which probably was a little bit too long, but took a year to verify the concept for myself and make sure that it wasn't too good to be true. So I networked with a lot of people in the industry, practiced analyzing deals because I come from an analytical background and mathematical background. Read up a lot of books and a lot of YouTube tutorials on what to look for in deals, what to look for in operators and the teams that you're investing with. Finally felt comfortable enough to take the risk and made the jump, took the leap of investing into my first syndication in an apartment building when I was 23. So that's September of 2021, 3 years ago now. Started seeing the cash flow coming in, and to me that was a proof of concept that, hey, this works. This guy didn't just run off with my money to the Bahamas. So I figured if I'm going to do this for myself, I might as well do it for my friends and family and others who are interested. So I started my company, Clive Capital, in January of 2022. And so our goal is to help tech professionals primarily and others invest passively into private equity opportunities. And I say private equity because we started out in real estate, but we're expanding beyond that now. So far, I've helped investors in general, but primarily employees from Amazon, Meta, Google, Microsoft, Apple, etc. A lot of the big tech companies invest passively into over 1,000 apartments under renovation, 500 single-family rental homes under development, industrial real estate like manufacturing warehouses. We should be having our first closing there here in the next few weeks. Private lending and oil and gas as well, primarily for the tax benefits. So our goal there is to help our investors passively build a diversified private equity portfolio that's usually delivering about 15 to 30% returns conservatively. But again, these are just projections. I'm not making any promises. But in addition to that, cash flow, right, passive income every month, and tax benefits as well. One of our biggest obstacles to wealth creation and wealth growth is our tax bill. So any passive and legal way that we can find to reduce that, we want to do. That's a little bit about who we are and what we do and how we got to where we are today.
That's wonderful. And especially, as you know, right, folks who, I spent, at the point I was a little ashamed that it took me this long to leave my corporate job. I was there, like you said, in front of a computer for nearly 2 decades. I did start investing and learning stuff along the way, but to extract myself took a lot longer than I ever imagined. But, people who are, busy in their jobs, their lives, never really probably get exposed to a lot of these things, right? To see that private equity, that may even sound scary, right, in terms of what that means, right? The public markets feel safe, right? They feel like tried and true and predictable, which we all know that's not true, right?
Yeah.
It feels that way.
Fun.
It's like a blanket, right?
Yeah.
It's what you hear daily. It's cool that you've kind of gone on that side, and it certainly aligns to kind of what we think at Prayer Pride, that, there are places for there's a place for public markets. However,
I disagree, but that's just me.
Yeah, at least for certain people.
Yeah.
Right?
Of course.
Because when you take people's financial lives into account, some of these things which I've experienced too, maybe lack liquidity all the time, right? Cash flows could be disrupted, and but again, this is where you look at things like Tiger 21. Biggest investors in the world, who've sold their businesses, their big bulk is in real estate and private equity.
Yeah.
They still play public markets because they serve a place, right, in a broader portfolio. So I love that you're introducing that, because I think most of the people you're probably dealing with are very concentrated, let's just say, in assets that, are public, and they have little to no control, and potentially are locked up in something they can't really access without penalty for a while, right? So it has other issues. So that's really great. So, and for folks who are listening too, there's, you mentioned tax benefits, all the things around it. There's a great book that I always like to plug. It's that guy, Tom Wheelwright. Right. You have 7 investments that will pay you, right? That the government will pay you. It's a fascinating book and gives you some lens on some of these things. So I highly encourage that.
Wait, what's the name of the book?
7 investments that the government will pay you to make.
Oh, I don't know that I have that one. I have another one. I think it's I forget what it is. It's another one. I can look it up here. But
yeah, the first one was like a tax-free wealth.
That's the one I have. Yes.
Really good. Yeah, all again complimentary, but it pushes you to think differently about it. It isn't just deferring money into some account that someday is going to be taxed. Right? That's not the game. The game is, okay, like you're doing, how do I save taxes legally and, follow what the government wants us to do, right?
Exactly.
It's all incentives. So with that in mind, that's really cool. I love it. So tell me, this is a kind of fund of funds model, right? So it isn't, some people may be familiar with a specific syndication. You're working with an operator. So talk more about kind of what you're doing, kind of how you started and how you've expanded on that over time. Like, tell me more about the model.
Yeah, sure thing. I mean, when I first started, my first investment was as an LP, right? A limited partner, a passive investor. I just put capital in. I didn't do anything else, and I got returns. And that's a great gig. That's a great setup for most people, I would say, honestly, with what they have going on and what they want out of life too. But as I started thinking beyond that one investment, each investment that you make as a LP, you want to diversify, and the way I think about diversification is in a couple different lenses. You could diversify across asset classes, right? You can invest in apartment buildings, you can invest in office buildings, you can invest in industrial real estate, you can invest in, and then even outside of real estate, right? Because all real estate is correlated in one way or another to interest rates and things like that. You can invest outside of that into, well, as I mentioned, oil and gas. You can invest into small businesses. So that's one lens, different asset classes. Then you can invest into different geographies, right? Apartment buildings in Houston, apartment buildings in Atlanta, apartment buildings in Phoenix, etc. You can invest in different types of business plans, right? Some business plans are very value add, middle of the road. Others are very opportunistic. And others are very stable core assets that are just, you hold them just for cash flow. There's no appreciation play really. And then lastly, there's different operators you can invest with, right? Investing in different companies. So with those 4 different ways you can diversify, you don't want to create, or it'd be a hassle to create an investment login in each portal. Or like with each company that you're investing with, it's a hassle to get a K1 from each different type of company. It's a hassle to sit there and evaluate each team, right? Hey, I got really comfortable with Oak Capital. Now I have to get really comfortable with Riverside Capital. And then I have to get, again, really comfortable with, Kolur Capital, whatever it is, Tom Capital. So the fund of funds solves all these different problems, and I really like it. Personally, I invest into my own deals, and then I obviously bring on my friends and family and all these folks in tech, etc. And anyone else who's interested, of course. It's easy for them because they don't have to create a login. That's the simplest thing. You don't have to create a login in 10 different investor portals. You have one portal that you can go through, which is like my investor portal, that you can go through to find all of the investment opportunities. Second, you don't have to do due diligence on 10 different operators and get comfortable with them. That is my job as the fund of funds manager, and my team's job is to get comfortable with different operators to help you diversify into different asset classes. So we take passive to a whole new level where we just bring you a buffet of investment options, and it's all you can eat. You can pick whatever you want. You can pass on whatever opportunities you want. And it's all in one centralized place for you to find. You don't have to go educate yourself on different asset classes. That's our responsibility that we do and happily take on for you. And lastly, I would say we hand you a single K1 for investments that you make through our fund of funds portal. It could be 50 investments that you make, you will still get a single K1. So I think that really streamlines things as well. Not only for you, but for your CPA too.
Interesting.
And those are
it's
big benefits.
I like the concept of it because it's funny, as here we are recording in March and what's on the docket, everyone's prepping their tax, right? Returns to be able to give it to CPAs. As you get into the view in your example, I got 10 different operators with different models, different portals, different K1 schedules. It can be chaotic and painful. And what happens on the other side is then your tax prep bill goes up, right? Because they have to do more work, right? Extend all those fun things. So you help sort of, streamline that by being able to say come to one spot, but you can have a variety of investments, whether oil and gas, real estate, private lending, you name it, in all different geographies and asset classes, but it's all in one shop, right?
Exactly.
And through you, right? And that's kind of what it is. Interesting. Yeah. Good. In that case, right, and I guess the biggest key is to trust that the process and I guess underwriting in sense like of the types of operators and the investments are good, right? And have a good sort of hopefully, outsized sort of potential for return versus the risk, right? A good profile with that. Can you help share with the audience here kind of how you go about doing that? Because they can be very different. I've experienced them very individually, like through over the years. And, I've made mistakes, as I kind of mentioned to you before we started recording. Like, how do you go about doing that? Like, what's this secret sauce, if you will?
It's taken a while for us to put our investment criteria together, but I like where it is now. And it's a fluid thing, but we look at investments from 6 different lenses, right? I just mentioned 4 lenses that you could diversify across. Here's 6 lenses that we look at our different types of investments, because there's thousands of investment opportunities out there, right? And we like to pick investments based on 6 criteria that we have right now. There's appreciation, pretty easy, right? How much is your asset going to go up in value? Whether that's market appreciation or forced appreciation, and we like forced appreciation. The stock market is market appreciation. There's nothing we can force there. Forced appreciation, we can take into control, our own control, and that's what we like. That's one of the big reasons I like private equity over the stock market, but we can, I can unload my hate for the stock market later on in the episode. But the 6 criteria is appreciation, cash flow, right? That's what we all want to retire off of or secure freedom off of is cash flow. Something that pays us fairly consistently every month. Stock market and asset values crash regularly, as in every decade, 2 decades. But cash flow is what keeps things going, right? Mm-hmm. Cash flow, tax benefits, right? How can we legally and passively reduce our tax liability? 4th is risk, right? Am I a really safe investor and I only want to invest in things on the same level of risk as apartment buildings? Or am I willing to YOLO on GameStop and Tesla and Trump coin? So that's a 4th lens that we look at investments from. 5th is liquidity. As you mentioned, not everyone can afford to lock up their money for 3, 5, 7, 10 years. So we like to present investment opportunities that have a lockup period of as little as 90 days to as high as 10, 20, 30 years. And then 6th is charitable investing, altruistic investing, impact investing. Some folks, and it's very admirable, want to invest not just for the profit, but also for some impact. So we like to bring those kinds of investment opportunities as well. Our goal is, whatever kind of investor you are, we want to have an investment opportunity for you that is, better than the stock market. If you only want to stick to index funds, 10% a year, no cash flow, high volatility, you'll notice a theme here. No, I don't know if I mentioned no tax benefits already, but if I didn't, no tax benefits. Then we're not the shop for you. But if you're looking to expand beyond that, if you want more than just 10% a year consistently, if you want cash flow beyond whatever sad 3 to 4% dividends you get in the stock market, if you want tax benefits, if you want reduced risk, then, come talk to us. Or come talk to you.
Yeah. And that's what it is. It's always, because... And I agree. I think this is where, obviously I personally have migrated to, because I see exactly what you're talking about, right? Once you start to learn more about it, you can't, I joke around, you can't unlearn these things, right? Once you start seeing it and then it starts expanding, you're like, oh my God, there's with my analogy I was telling you, like, most people are on this very narrow, comfortable road and will not get off the exit ramps, because it's comfortable, right? It's what they know, and what you're exposing is kind of a world that, is out there if people actually are willing to take an exit to learn more about it, and expose themselves to things, and, especially around taxes, like you could take the toll roads or the non-toll roads. That's how I view it, right? You have a choice, but you got to understand which ones are the non-toll roads, and how do you do that? And there's a lot of smart people like yourself, like you, like they're doing that and helping people understand it, right? Because I often get asked, like, where do I invest? I said, well, what the hell are you investing for? what's the purpose of it, like you said, like, and for what time frame, and kind of who you are as an investor. Like, all those things matter. Like, there's not one investment that's perfect for everybody, right? And that sounds like you can cater to that based on where they are in their lives and kind of what they're comfortable with and what they're trying to achieve, because you have a lot of different options, right? And that's cool.
Exactly.
Right?
Yeah.
That's awesome. That's awesome. Yeah, you know, with that in mind, like, as people get started with you, like, I mean, which is always a challenge with where I started too, with these types of investments, like, some of them need significant dollars to get in, some of them, right? So are there options within that, you know, people can slowly get in? That's why I guess the stock market is easy. You can have whatever, hundreds of bucks and get going, at least something, right? Unless it's in your bank account earning garbage. You know, from your lens, like, are there options for that, for people to kind of dip their toes in and get started, even if they don't have as much cash flow to contribute or a lump sum somewhere?
Yeah, sure thing. It definitely helps if you are what's called an accredited investor. That's someone who meets one of typically 3 criteria that's defined by the SEC, Securities Exchange Commissions, same people who monitor the stock market. Criteria 1's you earn over $200K per year alone for the last 2 years across your W-2, your investments, etc. Step 2, you and your spouse, or like option 2, you and your spouse combined earn over $300K for the last 2 years. Or option 3, you and your spouse's combined net worth or your own net worth is over $1 million, not including your primary house. And I think more people qualify for that than we realize in the country. I want to say 1 in every 15 people or so qualify for that. Just with, you know, how high the stock market's gone, right, and we've done really well. So it is still a privileged position to be in. But people might think that you need millions of dollars to invest into these syndications. Our investment minimum is $50,000. It's not as little as $10. I'm not saying it's no, small chunk of change, but it's not millions of dollars either. You don't need to be a yacht owner or have a golf club membership. It is a lot more accessible than it used to be. And this only changed recently in 2012 with the Jobs Act that expanded who could invest into these opportunities. So that's likely one of the reasons that you haven't heard about these types of investments. It's only been in the past 13 years that you can invest into these types of opportunities, or that it's become more accessible to the everyday person. And even then, there's a study out there that shows that people who make 200K, I think 200K or more, even at that financial level, 70% of people are living paycheck to paycheck. So I think it's just, unfortunately, mishandled finances that even within the people who do qualify, most of them can't budget well enough to save enough money to be able to invest into these opportunities. So that further cuts down who's able to invest into these opportunities, become aware of them, and discuss them. That's why a lot of people don't know about these things. If you want to get started, you have more money at your disposal than you think you do. We always tell people there's 3 ways to invest into these opportunities. 1 is pretty easy. If you have the cash lying around, liquid cash, right? Whether that's in your bank account collecting dust, whether that's in the stock market and you have to sell some shares and get that money out. That's option 1. Option 2 is using retirement accounts, right? If you have a 401k, usually from a previous employer, but you could check with your current employer if you could do this. Or if you have a Roth IRA, any other sort of retirement account, you can convert it, you can roll it over into what's called a self-directed IRA, retain a lot of the same tax benefits, and now use that to invest into these private equity opportunities. So even if you're cash poor, most people should at least have a retirement fund of some sort built up over the years. You can use that to invest and diversify. Rather than having all of it in the stock market, you can take out 50K, 100K, and invest it into these private equity opportunities, into real estate, into private lending, into small businesses, etc. And lastly, I wouldn't recommend this until you have experience in making these investments, but it's using leverage responsibly. Let's say you have, if you have a home or you have a stock portfolio, any asset, even art, the bank will give you a loan using that asset as collateral. The most common one that folks are familiar with is a HELOC, home equity line of credit. let's say the HELOC charges you, I don't know, I think market right now could be 8, 9, or 10%. If you invest that into an opportunity that's cash flowing you, let's say 20%, then you get to keep the spread in between, right? If it's giving you 20%, your loan's charging you 10%, you're making a 10% return. I would advise people to only use leverage to invest into cash flowing opportunities where at least your debt service is covered. At least I personally can sleep a lot better at night doing that. But those are 3 ways that people can invest. And even if cash is not an option, those are 2 other creative ways that you can invest with.
Yeah, I love that. Yeah, I agree with you. And I think more people are not as familiar with the self-directed space. It can be very powerful. And to your point, even some employers, even if you're working there, still will allow some rollovers. So I would certainly encourage folks to consider that if you're going down this path, to your point. And the leverage part is, I am completely on board with you. I think, there's a stacking method, right, leverage, and it is definitely not for the faint of heart and for people who are, can get, what's that term, over your skis, with, back to liquidity and things change, right? You still have debt obligations to worry about, and assets could drop. Homes could drop, stocks can drop, right? And then you have a different problem with calls and stuff like that. We use, in our world, we use also an alternative bank with like high cash value. Life insurance is also kind of a HELOC alternative. You can control the mechanism of it, and you control the term. So it gives you a little more, but again, it's the same concept, just like you said. You can't overextend yourself with it, and you got to invest in things that can be a little bit more predictable, because you got to pay that debt back, right? Maybe when you die you will, but along the way, especially person your youth, right? You got a lot of decades and more to go. You cannot let that compound, right? Those debts.
Yeah, and life insurance is a great point that you brought up. I'm in the process. I've been funding 2 policies now for the past year, and so I've been building that up as well. I would group that into leverage. It's a special kind of leverage, but same thing there. You build up an asset, which in this case is the cash value of the life insurance policy, and then you use that cash value as collateral, right? Let's say your life insurance policy is worth $100,000. Now you could take out a loan against that. Again, same thing. Maybe the loan charges you 5%, but now you invest that into something that's making you 20%, and you're profiting the 15% in between. So that's another niche. It's another category within leverage, but definitely a great point that you brought up, that people should definitely consider getting set up.
Yeah. But you gave people options, so they don't have excuses now. I don't have money. I have it. You can find it. Hopefully, if you get creative. And some people do, like you said. Unfortunately, I've run across people that have 7-figure incomes, but 7-figure expense cap budgets as well. It leaves very little room. You might as well make $100,000 or $50,000. It's all going to work the same way, right? You can't. Yeah.
Well, as they say, where there's a will, there's a way. So if you need to get something done and you have to, and it's a do or die situation, you will. And it's just it's a mentality thing, as everything else is in life at the end of the day.
Tell me more about and what's kind of new on the horizon. Anything you guys are really excited about your fund-to-fund model that people can be sort of thinking about? Kind of where's the evolution of that going?
Yeah, I think for us, our bread and butter so far has been multifamily value-add opportunities, typically like a 15 to call it 18% return per year. Pretty conservative. It's on the low end for us. I'm kind of an addict at this point, where my gateway was multifamily investing, and now that's not enough anymore. I need to kick it up to the next level. And so it's great. Multifamily is a great way to get in. It's a good amount of appreciation, good amount of cash flow, good amount of tax benefits, good very low level of risk. But now I'm looking for more. Right? I'm an addict. I'm looking for more. Looking for the next big thing. So I'm looking for things that have higher appreciation, higher amounts of cash flow, better tax benefits, right? I'm not saying it has to have all 3, but I want to find investments that have, that can do better, at least in one of those categories. So I'm really excited about oil and gas right now for 2 reasons. For cash flow and for tax benefits. It significantly outperforms real estate because, and my personal experience with this, I invested back in November of 2023. and we invested into an oil and gas opportunity. And every 100K invested, I got to reduce my W-2 taxable income by 80K. Like as a software engineer at Meta, I got to reduce my W-2 taxable income by 80K, passively and legally. Taxes have been filed. I have not been audited. Proof of concept there. In addition to those tax, and depending on what your tax situation is, deductions of 80K equate to a tax savings of about 30 to 40K. That's back in your pocket already. You could consider that a 30 to 40% return just in the first year alone. On top of that, I will say I'm not a CPA, just a quick disclaimer, that's just my personal experience. But on top of that, I've also made an additional 50% return already. So in the last 15 months, I've made about 80% return, 80. That 50% is through monthly cash flow. So the first 6 months or so, I was getting a 4% return. And then obviously, as time goes on with oil and gas, you have less and less that you can drill and extract. It is a depleting resource, so your returns decrease over time. So right now, I'm actually seeing about a 1.2% return per month. But the great thing is, in addition to when you combine the tax benefits and the capital, like the cash flow that you're getting, you'll have your capital back within the first 2 to 3 years, conservatively. Your principal is back, and the great part is you still cash flow even after that. It could be 1% a month or 0.5% a month, but that's free cash flow, infinite cash flow. You have no money in the deal. You can use your principal that you invested and put that back into another investment opportunity, but you're still making investment opportunity, or you're still making passive income from this investment opportunity into oil and gas. And especially with Drill Baby Drill, I think there's just going to be more opportunities to acquire the specific strategy that we employ. People might think that it's risky to invest into oil and gas. It is a little riskier than real estate, and it's also less well known than real estate. That's why I would say the returns are so great, because we are, I would consider, the early bird getting the worm right now. It's not, people aren't as knowledgeable about oil and gas as they are about real estate, and that's what excites us. So what we do is we go in, and when a company, let's say a private $1 billion oil and gas company, very experienced, they're coming in to drill, right? What that means is they're buying land in an area. When they buy land, they've paid geologists top dollar to confirm that there are deposits of oil and gas beneath the earth. They're not going to just go drilling every single square inch of this country. They're going to be very precise about it. So what we do is, once we know that they're going in to buy land and they know oil and gas is there, we go in and buy land right next to them. And what we do is we acquire what's called a working interest. And what that means is we put up capital not only to buy the land, but we actually put up capital to fund the drilling, like the equipment and things like that. What that does is we are entitled to a portion of the revenue, monthly revenue that comes. So I've been getting paid like clockwork every single month for the last 15 months from the oil and gas investment I made. On top of that cash flow, because we invested money into the drilling equipment and all of that good stuff, we are able to depreciate that equipment and claim that depreciation as tax benefits. And then there's other tax benefits that were given, like the depletion allowance, for example. Mm-hmm. That, I believe, says that the first 15% of income that you make from oil and gas investments goes untaxed, because they realize over time that your returns are going to decrease. So they want to incentivize investors. Even though over time this revenue stream is going to decrease for you, here's some candy, on the top. Here's a little cherry on the top. We won't tax your first 15% of income. I think it's every year, not just a one-time thing.
Yep. No, it's great.
But we're excited about that, and then we're excited about private debt. Just with where interest rates are right now, we don't see it coming down anytime soon. So private credit is doing really well right now, and it's, again, monthly cash flow. Really, there's a lot of good collateral backing that as well. So that's another space that we're really excited about. And this is a little further into the future. We haven't expanded into this just yet, but small business acquisitions. There's a lot of people who are retiring and their businesses are for sale. And there are firms out there who are starting to buy these businesses up. And so I think that's another space that we're really excited about beyond real estate. Real estate's a stable asset class. It's going to be the bedrock of our portfolio always, but these other three investment classes, I'm thrilled.
Yeah, I love it because one of the things we espouse here at Perennial Pride is one, invest in yourself, like getting educated, like people here listening today, getting your dose of education that keep you growing and learning, but investing in things that you have a little more ownership stake in, whether it's your business, right? Real estate acts like a business, right? You're owning a property, renting out. You're investing, the oil and gas part of it is you're owning that. You're having to participate, take the risks associated with, but has all these other benefits to it once you kind of understand it and get around the right types of people that will increase your chance of succeeding. It just takes a little bit more energy to sort of go down that path because, you won't see these things in your Fidelity 401k option list, right?
Yeah.
And that is the challenge. So it does take some more work to kind of do it, but just like anything's worth the squeeze, you have to put the work in, right?
Exactly.
And getting around the right people, and that's just simple, right? So really appreciate you coming today. How best if folks want to learn more about you and kind of what you guys are doing at Clive and maybe kind of connect with you guys, like how's the best way?
Yeah, there's a few ways. One is definitely reach out to me on LinkedIn. One of the one of the benefits of having a difficult to pronounce name is that there aren't many of you out there. So I'm pretty easy to find on LinkedIn. Definitely connect with me there. Would love to share, whatever I can to help you along your journey. Second is go to our website, clivecap.com/alternative-assets. And Tom, I think we've sent you the link if you could include that in the show notes, because spelling it would be a lot. We might be here for another half hour. And there we included a 2-pager, pretty quick read, as well as an ebook on why you should be investing outside the stock market. And like you mentioned, I don't know if it was on the podcast or before we started recording, but most of the ultra high net worth individuals, people who are worth 30 million or more, I believe, most of their portfolio is not in the stock market. It's primarily in real estate. About 25% of it or so is in their primary and secondary homes. And then another 25 to 35% of it is in private equity opportunities, whether that's real estate, it could be, buying small businesses, things like that. And then stocks are in third place. Mm-hmm. So we have to take note from what people are doing at that level, right? Success leaves clues. And then we also include a due diligence checklist. Like you mentioned, this exciting world of alternative assets is great, but you have to make sure you're investing with the right people. There are definitely the wrong kind of people out there. Like, if you don't do your due diligence, you will lose money. It's not all butterflies and rainbows. It gets pretty dark. You can lose money. And the primary indicator of that is who you're investing with. So this due diligence checklist, about 100 questions or 110, you can use no matter what you're investing into, whether it's real estate or oil and gas, private debt, small businesses. Ask this person these 100 questions, and that will, it'll give you an idea of who you're investing with. And some of these questions are the simple ones, right? Like, give me testimonials of people who've worked with you. Tell me about a time a deal went bad. What did you learn from it? What did you change, etc.? How did you handle it? So that's our website. A lot of great educational resources, and we just revamped it recently, actually. So pretty excited about that. There's a link to our investor portal too. If you're an accredited investor, definitely check that out. And then lastly is our podcast. We host our very own educational podcast called Investing for Generational Wealth, hosted by my business partner, John Lai. Definitely check us out there. Give us a review. Give us some feedback. And Tom, would love to have you on there as well.
Awesome. Well, listen, you've given us so many great nuggets and sort of ideas to even just kind of get started and resources. This is awesome. We'll make sure it's available for listeners and share it across once this airs. But I really appreciate your time, and you're I see you're driven and, like you said, motivated. When you're motivated, it all can happen. You just got to take steps forward. So listening to this podcast is a start, but you got to take further action. So I encourage you to do that to kind of shape the life that you actually want to live, not someone else's life. So thanks again for joining us, and we'll see you on the next episode of the Perennial Pride Podcast.
Thanks for having me on, Tom.
Thanks for joining me on this episode today. I really am grateful for you as listeners to the Perennial Pride podcast. I hope you're getting some tremendous value out of it and hopefully pushing you along your journey to financial freedom. I put this podcast together really to help you get more educated around your finances so that you feel empowered to live the life that you really want. And if you like the content that you heard today or watched, then I would encourage you to go to my website, perennialpride.com. There's tons of other content there. And you can access my book, Wealth Beyond the Numbers. You can buy it there on my website. It's a aggregation of a lot of great tips and tools I've learned to not only build my wealth in my accounts, but build wealth in my life and abundance and joy, and something that has a lot of my experiences in the journey that I've been on personally. Hopefully that can be also of value to you as you sort of move forward. So thanks again for being a Perennial Pride listener, and we'll see you on the next episode.